Hello everyone. In our last lecture, we have discussed a brief overview of principle-based 5-step model for revenue recognition under IFRS 15. Let's recall the same quickly. Step 1 is to identify the contract with the customer. Step 2 is to identify the performance obligation, that is distinct goods and services in the contract. Step 3 is to determine the transaction price of the contract. Step 4 is to allocate transaction price to each performance obligation on the basis of standalone selling price of each performance obligation. And finally, the last step, step 5, is to recognize revenue as and when performance obligations are satisfied. In our last lecture, we have discussed about the importance of this standard IFRS 15, its objective and its relevance for the stakeholder of the company. We have also covered an illustration on this 5-step model for revenue recognition. As promised in our last lecture that we will be covering each steps in greater detail with multiple illustrations and practice questions. So the agenda of today's discussion is to cover step 1, that is to identify the contract with the customer. Today we are going to dive into the detailed concept behind this step. First of all, if we see the simple definition of a contract, contract means an agreement between two or more parties that creates enforceable rights and obligation. It's mean contract is a promise between two or more persons, between two or more parties that establishes their rights and obligation. Now, enforceability of the rights and obligation in a contract is a matter of law. Depending upon the norms and the regulations of the market in which we are operating, depending upon the local practices where we are conducting our business, a contract can be a written contract, it can be a verbal contract. Even it can be an express or implied by the entity's customary business practices. This is the simplest definition of a contract. But in order to establish an agreement as a contract under IFRS 15, it needs to fulfill some criteria, some attributes. Basically, IFRS 15 requires a contract to have 5 attributes. And when these 5 criteria or attributes are present in an agreement, it will be considered as a contract under IFRS 15, and then we will apply later steps of the 5-step model. We will discuss these 5 criteria or attributes in some time, but for the time being, we have a simple definition of a contract, that a contract is an agreement between two or more parties that create enforceable rights and obligation. Normally, in case of a two-party contract, one party, that is company, provides goods and services to the other party, that is customer, and the customer pays consideration against those goods and services. It's mean in a contract the responsibility of the company is to provide goods and services to the customer, and the obligation of the customer is to pay consideration, is to pay for the goods and services to the company. Now, when we talk about a contract, most people think that a contract should be a written contract, and it is necessary to have a contract in a documented form in order to be legally enforceable. But this is not necessary at all. IFRS 15 says that the format of a contract depends on the market in which we are operating. It depends on the market in which we are running our businesses. What are the norms there, what are the regulations there, what are the local practices there, and what are the local laws and the rules and regulation of the jurisdiction in which our company is operating. Therefore, depending upon the market norms, depending upon the market regulation, depending upon the market practices, a contract can be a written contract, it can be a verbal or oral contract, even a contract can be in an electronic form. For example, practically when we purchase some land or building, we definitely do a written contract. But when we want to purchase something from a grocery store, then we don't do a written contract there. We just gift our order verbally and the shopkeeper gives us the good and we pay the consideration against it and our contract gets closed. So if we are going to purchase something from a grocery shop or some supermarket, the norm there is that contract gets concluded verbally. In the same way, if we buy something online, any goods and services from any online store, whether we have ordered something from Alibaba or Amazon or any other online platform, then in this case, the contract has not been executed in the written form or verbal form, but in an electronic form. So the crux is that the contract should be an enforceable contract. It does not need to be in a written form. It depends on the market we are operating in. The contract can be in any form, but it should be enforceable. It can be a written contract, it can be a verbal contract, it can be an express or implied by the entity's customary business practices. This is the general dictionary definition of a contract that we have discussed. We need to keep one thing in our mind, that if in any agreement, in any contract, every party of the contract has a right to terminate the wholly unperformed contract without compensating the other party, then there is no contract under IFRS 15. I repeat, if in a contract, every party to the contract has right to terminate the wholly unperformed contract without compensating the other party, then there is no contract under IFRS 15. But yes, in a contract it may happen that one party has right to terminate and the other party does not has the right to terminate. In a contract it is possible that some parties can terminate the contract and some cannot terminate the contract, and this can be a contract under IFRS 15. But if in our arrangement, in our agreement, every party has the right to terminate the wholly unperformed contract without compensating the other party, then there is no contract under IFRS 15. Let me give you a simple example. Let's say a student comes to me and tells me that he has seen some of my lectures on YouTube. He has seen some of my teaching clips on social media or has seen some of my podcasts and is very much impressed with my teaching style. And in the coming time, he will buy some course from my institute or get himself registered, enrolled in my course. And there establish an understanding between me and the student. After some time, the student may take enrollment in my course or he may not get enrolled. There is no binding contract between us. It is possible that student never appear again in the future. In this case, I cannot force him for any penalty. It is also possible that I do not offer that particular course in the future. Do I have a promise to offer the course, or do I have an enforceable contract that I will offer the contract? Of course not. So it may happen that I do not offer the course in the future, and in this case the student cannot compel me for any penalty or compensation. So the point is, if every party to the contract has a right to terminate the wholly unperformed contract without compensating the other party, then there is no contract under IFRS 15. But yes, some party may have right to terminate and some parties do not have the right to terminate. This can be an established as contract under IFRS 15. But if every party has a right to terminate the wholly unperformed contract without compensating the other party, there is no contract under IFRS 15. We have a simple illustration to understand this concept. It says, a shopkeeper agreed to deliver 10 computers to Warner Enterprises within 3 months. As per the contract, the shopkeeper or the Warner Enterprises can cancel the contract anytime before the delivery. In case of cancellation, the shopkeeper or Warner Enterprises is not required to pay any penalty. See, there is an agreement, there is an arrangement between the shopkeeper and the Warner Enterprises that the shopkeeper would be delivering 10 computers to the Warner Enterprises within a period of 3 months. And agreement further states that if before the delivery, the shopkeeper or the Warner Enterprises cancels the contract, they are not required to pay any penalty. So in this case, both the parties can terminate the contract without compensating the other party. This means there is no contract under IFRS 15. I have also drafted a simple solution for this. Let's read it. It says, a contract does not exist if each party, either buyer or seller, has enforceable right to terminate a wholly unperformed contract without compensating the other party. As shopkeeper can cancel the contract without compensating Warner Enterprises, and Warner Enterprise can also cancel the contract without compensating the shopkeeper. Therefore, there is no contract under IFRS 15. But once shopkeeper delivers the computer, now Warner Enterprises will be bound to pay the money. Or once Warner Enterprises pay the money, now the shopkeeper will be bound to deliver the computer. So until one party to the contract fulfill its obligation, fulfill its duties, then the contract will not be established. So far, we have discussed the general definition of a contract. Now, as I discussed earlier, an agreement need to have at least 5 criteria, 5 attributes. Only then such agreement will be considered as contract under IFRS 15. Only then step 1 out of the 5-step model will be completed, and then we will apply the later steps of the 5-step model. So let's see the attributes of a contract under IFRS 15. It says an entity should account for a contract with a customer under IFRS 15 only when all the following criteria are met. Number 1, parties have approved the contract either in writing, orally, or as per the customary business practices and are committed to perform their respective obligation. It's mean all the parties in our contract have shown their approval toward the contract, they have shown their commitment toward their obligation in the contract, and that commitment can be in the written format, in the oral format, in the verbal format, or in any other format. For example, if there is a 2-party contract, one party promises to provide goods and services to the other party, that is customer, and the other party, that is customer, promises to pay consideration for such goods and services. So the approval of the parties and their commitments toward their obligation is the first criteria that our contract will be made. After this, the second criteria is that each party's right to the goods and services can be identified. It means that the underlying goods and services of the contract, the underlying performance obligation of the contract should be identified. After this, the third criteria is that payment term for the goods and services can be identified. See, if in a contract one party is providing goods and services to the customer, then obviously customer is to pay some payment against those goods and services. Now when we talk about that payment term should be identified, that it does not mean that payment should be fixed. In most of the cases, we will see that payment term or consideration for the goods and services is fixed. But payment term can also be made variable or contingent consideration as well. For instance, it may happen in a contract that different prices may be agreed depending upon the quality of the goods and services provided. For example, higher price for better quality and lower price for inferior quality product. Similarly, different price may be agreed depending upon the completion of a contract work either before or after some decided deadline. So it is important to identify the payment term. It may be fixed payment, it may be variable payment, it may be contingent payment depending upon any future event. After this, we have the fourth criteria that the contract must have a commercial substance. That is, the risk, timing and the amount of the entity's future cash flow is expected to change as a result of a contract. In the fourth criteria, it is said that the contract should have a commercial substance. Means this contract should be an arm's length contract between the independent market participants. For example, in case of a transaction between group companies or in case of transaction between related parties, the contract may be executed at a price that is not the market price, or the transaction is not on arm's length basis, or the transaction does not have a commercial substance. In this case, we will be presenting and disclosing such transaction, such contract according to the standard IS 24 related party transaction. In order to have a contract under IFRS 15, it is important that the contract must have a commercial substance, means it is executed on arm's length transaction, arm's length basis between independent market participants, and the contract should be executed on arm's length basis. And the last criteria is that it is probable that consideration will be recovered. It is probable that consideration will be received from the customer. Here, we will evaluate two things. Number one, the customer ability to pay, and number two, the customer intention to pay the amount when the consideration is due. At times, we may have such a customer who has a very good reputation. He never betrays, but he is going to bankrupt soon or has already bankrupted, which means that the intention of the customer is to pay, but the ability is not there. Based on both the ability and the intention of the customer, we will assess whether we will recover the consideration of our contract or not. According to IFRS 15, if in an agreement these 5 attributes are present, only then the contract will be established under IFRS 15. And only then our step 1 is completed, that is to identify the contract with the customer. Once step 1 is completed, then we will apply the later step, that is step 2, step 3, step 4 and step 5 to recognize revenue under the principle based 5-step model. Now, here a question arises that what if we have an understanding with our customer, we have some agreement, we have some arrangement with our customer in which one or more of the 5 criteria or attributes are not fulfilled, then what we will do? In this case, IFRS 15 says that we should continue to assess our contract against the above criteria. If the criteria are met in the future, only then we will apply IFRS 15 revenue recognition model. Till all the 5 criteria are not fulfilled, we continue to assess our contract again and again after every update, after every interval. And once these 5 criteria are fulfilled, only then we will have to move to the next step of the 5-step model for revenue recognition. It may also happen that the company has some sort of understanding, some sort of agreement with the customer in which one or more of the 5 criteria are not fulfilled, and the company has already received the consideration from the customer. In this case, IFRS 15 says that entity should recognize the consideration received from the customer as liability until the criteria for the contract are subsequently met or one of the following 2 events occurs. Event number 1, the entity's performance is completed, substantially all the consideration has been collected and it is non-refundable. Or event number 2, the contract has been terminated, the consideration received is non-refundable. If a contract does not meet any of the 5 attributes, any of the 5 criteria, and the company has already received the consideration from the customer, such consideration will be initially recognized as liability. Now, there are 3 possible scenarios in this case. Scenario number 1, the 5 attributes of the contract are subsequently met. In this case, we will apply the 5-step model under IFRS 15. Scenario number 2, the company's performance under the contract is completed and the consideration received is non-refundable. In such case, consideration will be recognized as revenue. And scenario number 3, the contract is terminated, the consideration received is non-refundable. In this case, such consideration will be recognized as revenue. Let's take a look at a simple example to understand this. Mr. Alexander agreed on 1st March 2007 to sell 5 cutting machines to Exim Enterprises. Due to some deficiency in drafting the agreement, each party's right cannot be identified. On 31st March 2007, Mr. Exim delivered the goods and they were accepted by the Exim Enterprises. After 10 days of the delivery, that is 10th April 2007, Exim Enterprises made the full payment and the payment is non-refundable. Requirement says when should Mr. Alexander recognize the revenue? Now, in this example, there is an agreement between Mr. Alexander and the Exim Enterprises on 1st March 2007. Under the agreement, Mr. Alexander has to supply the cutting machines to the Exim Enterprises. But there is some deficiency drafting the contract and due to which the right of the parties are not identified. This means that the criteria of the contract under IFRS 15 is not fulfilled, so we cannot apply the 5-step model of IFRS 15. Now, on 31st March, Mr. Alexander delivers the machine to Exim Enterprises and Exim Enterprises accepted those machines. This means that on 31st March 2007, Mr. Alexander has fulfilled his obligation under the contract. Now, even though the performance obligation of the contract has been satisfied on this date, that is 31st March, but we cannot recognize revenue on this date because the criteria for the contract was not fulfilled. Then after 10 days of delivery, on 10th April, Exim Enterprises paid the consideration against the cutting machine and the payment is non-refundable. Now, in this example, criteria for the contract are never fulfilled, so we cannot apply the 5-step model under IFRS 15. Mr. Alexander performance under the contract is already completed on 31st March and then on 10th April he has received the payment which is non-refundable. So the revenue should be recognized on 10th April 2007. So till now, in our today's discussion, we have discussed the step 1 of the 5-step model for revenue recognition in detail, together with some practice questions, together with some illustrations. I hope I have been able to explain these things to you. Thank you.